Investors, the little momentum that was built up over the past few trading sessions has disappeared, and here we are coming up on the end of January with what could very well bring some worrisome news for investors, but more on all of that to come. If you are brand new to the channel, I'm Ari. This channel is all about dividend and value investing, so if that's up your alley, you're certainly going to enjoy today's video, in which I'm quickly going to update you on my personal brokerage account, cover some macro market news for you to be aware of, and then get right into the 7 dividend stocks that you should have on your watch list for our week ahead. But before we actually dive in, my big ask for each and every one of you is to simply tap on that thumbs up button, which helps me spread the word of this channel, and to join me if you are that dividend or value investor on YouTube looking for, well, a trusted channel, which only requires you to tap on that subscribe button. With all of that said, let's dive right in. So after a couple of weeks worth of market momentum, my account jumped to $103,556.02. But the closer we get to the end of the month, the more worrisome investors are becoming. You see, on February 1st, the Federal Reserve will pop out of their blackout period and deliver the news of the next interest rate hike. While many over the last 2 weeks thought we could see a pause or a pivot, I kept to my predictions and will share again now. Powell is not here playing poker with the market. This is to say, we could very well see another 50 basis point hike, or at minimum, which I think will be the case, a 1/4 of a basis point rate hike. Now, ultimately, the loss in momentum this past week stemmed from weaker than expected economic figures like retail sales data and the producer prices, both pointing to growing sluggishness within the US economy, which is actually a sign that the Fed's moves are working. But the trouble comes down to whether companies really can withstand all of the pressures from higher and higher interest rates. Thus far, we see companies have been fine. A weekly data on jobless claims fell to the lowest level since September, which again is another sign that the labor market is just incredibly robust, and this is opposite of what the Fed actually desires in order to rein in inflation. Now, what do we need to see for the Fed to actually pivot? Higher unemployment. If you're asking me what I really foresee, well, in roughly 6 to 8 months, at least a mild recession, which we will find ourselves in when wages stop increasing and unemployment is higher. But our most foretelling sign we're going to get closer and closer to an entry into a bull market will be layoffs across sectors, which we have only really seen happening within the tech sector. Now, mark my words, there will be more pain ahead before we truly see through to the other side of all of this madness. Now, am I telling you to time the market? No, absolutely not. Now is the time to prepare for the worst while planning for the best. How exactly do we do that? Dividend and value investing, which leads me to our 7 dividend stocks that I think are worthy at minimum to add to your stock watch list this week. Our first dividend stock of the day is Dover Corporation, ticker symbol DOV. Now, that is an indispensable player across industry verticals, given the nature of their business in manufacturing innovative equipment, components, and aftermarket parts ranging from anything like refrigeration systems to the machinery used to manufacture car tires and wheels. Dover most certainly is not the sexiest of investments, but the business is a necessity for us all, making Dover a lower flying, under the radar type of investment. Dover has proved itself to be a time-tested dividend investment as well since its inception in 1955, amassing this $19.72 billion market capitalization. However, with all the supply chain disruptions and of course businesses across the board doing what they can to reduce expenditures, Dover took a hit over the last year, to which we see its share price down nearly 20%, trading for around $140 at this time. But let's think ahead, especially with their PE ratio at just 17.9. This could be a safe opportunity for investors, and a matter of fact, smart money is ahead of us, with plenty of hedge funds already having bought more shares last quarter. Cross-checking with analysts, here we can see upside potential predicted, with the share price coming up to $150 per share, which is about 6.75% worth of upside. And while Dover does not exactly shell out the largest dividend, again, reliability is key for some investors. to which Dover will deliver as a dividend king with its dividend yield coming in at 1.39%. Speaking of safety and reliability, this next dividend stock delivers on just that. Let's dive into General Dynamics, ticker symbol GD, which is a global aerospace and defense company that as of this video is the 5th largest defense contractor in the world by arms sales and the 5th largest in the United States by total sales. Now, anytime we're talking about defense contractors, I like to note that they do business with the government, selling anything from tanks to tactical and aviation systems, with every contract not only being worth billions, but contracts that last for years to decades plus. So of course, that market capitalization is there with General Dynamics above $65 billion. And while General Dynamics is not exactly as beaten down on the year, only down by 4.67%, trading for $237 per share, the opportunity for the long term is what makes it an attractive investment right now, especially with a lower PE ratio compared to its competitors, coming in at just 19.7. As for smart money, of course, they have been scoring more shares worth of General Dynamics, which will likely be for the longer term, and analysts are also favoring this defensive play with nearly 20% worth of upside expected, with the share price jumping to $283.33 per share. Now, in terms of General Dynamics dividend, they have you covered there too as a dividend aristocrat, coming in with a dividend yield at 2.06%. Moving right along, I want to talk about Bank of America, ticker symbol BAC, which I don't think needs much of an introduction, but you should know it is the 2nd largest bank in the United States by assets under management of over 2.41 trillion. And while JP Morgan is often spoken about on YouTube, Bank of America, in my opinion, can be much more of a lucrative investment. Over the years, Bank of America has really cut costs and has done a great job appealing and adapting to younger demographics with their digital banking strategies. As of this video, Bank of America's market capitalization is just above $270 billion, but investors, have a look at what we have here in terms of their share price, down over 25% on the year, trading for just $33.72 per share. And there may be more pain coming their way after some news of customers recently reporting issues with payments processed through Zelle. In short, customers were reporting money that just disappeared from their accounts. And this will all make for near-term trouble, which could result in opportunity for us as investors. So bring on the negative headlines. In terms of their PE ratio, it is at just a low here of 10.8. Now, of course, it is very likely we're going to have an entire year worth of elevated interest rates, which is good for banks, and smart money understands that best, which is why we see a lot of hedge fund activity when it comes to Bank of America. But looking to what the analysts are sharing, they are also optimistic with a target share price coming up to $40.53 per share, which is about 20+% worth of upside. And until Bank of America is back on the up and up, they will be rewarding their shareholders with a dividend, with that yield coming in at 2.44%. Coming up on our 4th dividend stock that actually attracted the likes of Warren Buffett, I want to dive into Celanese, ticker symbol CE, which is a global chemical leader producing chemical solutions for various industry verticals. Whether we're talking adhesives, paints, and coatings, or medical devices to sweeteners, Celanese very well could be playing a massive role in all of it, which makes for another under-the-radar flying opportunity that has been in business since 1918 and has managed to amass a $12.87 billion market capitalization. Yet similarly to our first 2 dividend stocks, Celanese has been hit by our economic conditions, whereas it is down by over 27% in the year, trading for roughly $118 per share, with a PE ratio coming in at just 7.9. So in my opinion, given smart money moves with Buffett leading the pack, given his $877 million position in Celanese, as well as analysts foreseeing upside of a little over 4%, bringing that share price to $123.54. I'm here saying you may be interested in adding it to your portfolio as well. You will also then reap the benefits of collecting on their dividend, which is coming in at a dividend yield of 2.26%. The 5th dividend stock that I want to bring to your attention has actually taken quite a beating given the cut in consumer spending and penny pinching. We have good old United Parcel Service, or better known by their ticker UPS. Investors, it is one of the largest, if not the largest, shipping company in the world, Need I detail more about this $152.83 billion market capitalized logistics leader? I think not, but do note its stock share price given the 10.4% drop in its share price as it trades for $176 per share, along with that rather low PE ratio coming in at just 14. I think there's a solid opportunity for a buy, hold, and relax type of investment, given analysts are only expecting upside for UPS coming up to a share price of $196.25 per share. It's about 11% worth of upside, not to mention smart money moves being made with plenty of hedge funds pouring millions into this logistics leader. As for UPS's dividend, shareholders will be able to enjoy their dividend with a dividend yield coming in at 3.34%. Next up, a dividend stock that I really don't know why I've never really mentioned, but sure do enjoy what they quite literally bring to the table. It's Kellogg's, ticker symbol K. From their cereals to Pop-Tarts, popcorns, and Cheez-Its to, let's face it, everybody's kryptonite, Toll House cookie dough. This is a company that you should be invested in if you have enjoyed and continue to enjoy their foods and snacks. Now, as that share price is sliding down almost 5% over the last few months, trading for $67 per share and a PE ratio at just 16, Kellogg's may soon turn into a very ripe investment for long-term investors. And I think it's safe to say that Kellogg's $22.98 billion market capitalized industry leader with brands that they bring to all of us that won't be leaving our tables anytime soon. As for hedge funds, some have already begun to buy into Kellogg's, but I think more will be following suit should that share price drop lower. And in looking to the analysts, the upside potential is there, with 7.23% worth of it predicted to bring Kellogg's share price up to $72.20 per share. But the best part of investing into Kellogg's, it's that dividend that they're ultimately going to help you to pay for the snacks and maybe even a gym membership, given that dividend yield of theirs is coming in at 3.34%. And finally, our last dividend stock that has certainly seen a heck of a 2022, which very well may see more momentum in 2023. Let's talk about Energy Transfer, ticker symbol ET, which is one of the largest and most diversified midstream energy companies in North America, transporting natural gas and propane within their pipelines that stretch over 120,000 miles. With their $38.64 billion market capitalization, at least a short-term interest for better pipeline infrastructure within the United States, Energy Transfer is in a really solid position to just reap continued success. So seeing its share price up 40% over the course of the last 12 months makes sense, but it's notable that their PE ratio is still low at 9.4, and plenty of positive signs here, like their own insiders doubling down on the company, buying more shares, to hedge funds also building up their Energy Transfer position with millions being invested. But looking to analysts, we see even more positivity with over 35% worth of upside projected for Energy Transfer, as it's rated a strong buy with a target share price of $17 per share. And in terms of Energy Transfer's dividend, while it may not be the most stable given the payout ratio is rather high at almost 65%, the yield itself is at 6.87%. Now investors, there you have it, from Dover Corporation and General Dynamics to Bank of America, Celanese, UPS, Kellogg's, and Energy Transfer, the 7 dividend stocks that I am telling you to perform your own due diligence on and add to your watch list should any or all of them be suitable for your dividend stock portfolio. Of course, be sure to leave your thoughts on these dividend stocks below with a comment, and let the community know if you have your eyes on other dividend stock opportunities while you're at it. Oh, and also don't forget to click on that thumbs up button, as it greatly helps me out in growing this channel. Your subscription to the channel is also valued. I want you on this journey with me. And with all of that being said, until the next video, I will see you all there.